My name is Rohit Arora. I'm a co-founder and CEO of Biz2X.
Rohit, welcome to the Founder Thesis podcast. Let me start by asking you to give a short intro. Who is Rohit? What is Biz2X? What have you built?
Biz2X, we are a digital lending fintech headquartered out of New York. We have two sides to the business: lending sides to the SMEs, which we do and predominantly focus in the US markets. And then we have our platform business, Biz2X, where we provide our technology, our data analytics tools, as well as our AI, agentic AI based offerings now to a large number of financial institutions, as well as players like major payment processors, payroll companies, insurance companies. So anybody who's dealing in the SMB space. And that part of the business we have in US, Middle East, in UAE and Saudi markets, as well as in India also.
Let's start with the lending business. So, the lending business is what you originally started in the US. How did an Indian end up starting a lending business in the US? How did you pull that off? And that too, it's like such a regulated space and all.
So basically, when me and my brother we were in I moved to US in 2003, and he had moved 2 years earlier than me, and we were looking.
This was like for job, for employment. You got a job there.
Yeah, yeah. So for job and but we were very clear that we were gonna set up our own like a startup, especially with the internet economy was coming back after the dot com burst. So the idea was to look into some of these opportunities, and then when Steve Jobs launched the first smartphone in 2007, it was very clear that now things will totally change, because instead of people sitting behind a laptop or a desktop, now people will have first time internet in their hands, because prior to that in US people had Blackberries and some of these phones with basic email capabilities, but there was nothing like where you could browse the net or you could do everything on a phone. You didn't need a like a fixed device anymore. So that was a very big, I would say, aha moment for us. And then living in New York, working and living in New York, we also figured out that small businesses were underserved in that market, even in a market like US, where access to credit and credit availability historically has been one of the highest, and they have the best capital markets in the world and the most sophisticated one. But still that was a gap. So we said, like, how do we marry the advent of smartphone with solving a problem which at scale could not be done in the past without having a technology platform. And that's how the idea came around in late 2007 or early 2008. And then we started the company sometime in early 2008 in New York itself. And our big other finding was that businesses have five big touch points: payroll, payments, filing taxes, doing their marketing stuff, and then managing their growth, kind of stuff. And this is, I'm talking about pre fintech or pre API eras. But we figured out that very quickly that for these businesses, because business owners are normally very busy people, they don't have time to do, because look for access to credit, while at the same point of time, credit is their cash flow, or their bloodline. Where cash flow is bloodline. Without capital they cannot operate. They have to pay to their suppliers, vendors, employees, everybody all the time. And unlike consumer, businesses need credit on a day-to-day basis, to run and operate their businesses. So we said, how do we go and fill out this gap? And that's how the whole idea around Biz to Credit came. And then initially 2 3 years we were just a marketplace where we were matching business owners with lenders and other folks. And then after that, we also figured out that if we want to improve the execution piece, then we'll have to have a mechanism where we also control the actual flow of funds. And then we actually came up with a very unique value proposition where we got, initially this was in 2011 2012, some of the hedge funds which were based out of New York, and also credit funds to partner with us, where we said that we'll take the actual underwriting, final underwriting decision, and then we will actually, fund them through this third party money, and then, keep managing these portfolios from a risk perspective, collection perspective, and everything. So that was actually a very big innovation in the market, because traditionally people thought that if you have to lend, then you need to have your own balance sheet, you need to have your own, ways to, just do it. And that was from a regulatory aspect also. It helps us not to be over regulated, because one, we were not using any retail depositor money, and secondly, we were not the final lender of record. And then, and that started happening, and then over time, the adoption of digital became bigger. And then, fast forward, COVID came along, and after COVID, the growth has been very, very high, because, obviously, things have moved so much digital, now, that, that's how, the growth has happened. And now with the advent of AI and data play and everything, my view is that it's going to get even bigger and better.
So when you started the marketplace, was that regulated, or you can just start saying that find like say Pesa Bazaar, Policy Bazaar, all of these are like say selling insurance policies not of their own. So probably it's more of a marketing company that they have created. So was it something similar that what you created was essentially a
Yeah,
marketing?
yeah. So in US also, at that point of time, since marketplace was such a new concept, that regulation was not there. And US, unlike India, a lot of the financial services regulation is state by state. It's not federal.
Okay.
So there are states where they will regulate you more, and then there are states where they don't regulate you much, because they want to attract more businesses. So regulatory regime is also a source of arbitrage in that country, unlike India, where, it's mostly federally regulated only. So that's why it was not there was not a very high level of regulation. Obviously, there was basic regulation which had come in, especially after the mortgage meltdown and everything, because what people didn't want is that, non-serious actors or, fraudsters to be there. But it was not as regulated as if you were a bank, kind of a stuff, where, you needed all kind of licenses, and it took you years. And then there was examination by the, various, like Federal Reserve offices and all that kind of stuff. So that way it was less regulated. And then, since we were also not touching any depositors money, because till you don't touch depositors money, there'll be less regulation, than more. And I think the other thing in a country like US, unlike India, is that the capital markets are very innovative and dynamic, so they like trying new things. And that's where they let people, experiment with things, unlike in India. And that has led to a lot of this growth over time, and a lot of understanding also, that, how these securities work, markets work. And then, and a lot of regulatory stuff actually comes by, like, from rating agencies and all that, when they rate you, because
Hmm.
if you're not compliant, or your portfolios are not doing well, then your rating will go down, actually.
Okay. The marketplace model would essentially assess the credit score. Like somebody would sign up, submit their whatever number, unique identifying number through which you would get the credit score, and then you would pass on the credit score to lenders who want to lend, and they would take the decision on do I want to lend or not, and at what rate, etc. That's how it worked.
It is a little different in that, because yes, credit score plays a part, but since this is all B2B lending, so there, you have to be also looking at the underlying, business asset, how their cash flow is happening, what their historical financials look like, how their projections look like, what kind of business they are in, how good the operator of the business is, how much experience they
Does an
have.
SME owner have the time to share all this information with you? It sounds
It's
very
not a
cumbersome.
question of sharing the information, because now the good thing is that they don't have to share all that information. They have to just connect their, like, let's say, their digital business bank account, and then we can take all that data with the permission of the business owner, with their consent,
Okay.
and can run all kind of analytics analysis. And then we also have other third party databases that we can access to, fill out the rest of the gaps. So I think the benefit of now digital is that, as a business owner, you don't have to give us much of information. You have to just give us some level of consents, and then after that, most of the data is now pretty much available. And then the machine learning and AI makes sense of it now, in terms of analyzing it, ability to go and do things in a way that were not possible earlier.
But when you were running the marketplace at that time, you had all of these pieces in place.
Those were still very early days, but I think like at that point of time, business owners used to upload their bank statements, and then we had
Hmm.
a team of people who used to like look at it. So obviously, from those days, things have changed quite dramatically. Online connectivity was already there, in 2012 onwards. So that's where we could look at it and could be done, but it was still very early days. Over
Hmm.
time it has improved quite a lot. So like initially there was a lot more manual work, but there also at that point of time business owners had to just upload their last 6 months of bank statements or a year of bank statement, and then with their consent we could pull their text data from IRS, and all that
Okay.
was available. But now it has become very seamless, fully integrated, fully automated. That wasn't the case earlier.
Okay, got it, got it. Okay, so till 2011, you were just a pass through. You were like an introducer. You were not responsible for the decision or for the collection, if I understand correctly.
So basically, we were a pass through, but we were still scorecarding all these, businesses, because we were collecting all the data and everything.
Okay,
And then the final decision was being made by third party lenders, and then they were responsible for servicing and collection of these portfolios also.
but I guess by then you would have built enough data to get into lending yourself. Like the advantage you had as a marketplace was the access to data, which would have allowed you to create stronger decision making algorithms.
Yeah, yeah. So that was the biggest benefit, that we could see all the data, including the customer behavior data, and customer used to come back to us for more access to credit and everything because they were getting more choices.
Hmm.
So we could actually see all the data, and also part of the performance data and everything, and that gave us a lot of like insights into how to build the right kind of lending products.
Hmm. Okay, interesting. And essentially, you were leaving money on the table by not lending yourself.
It was
Like,
not a question of leaving the money on the table. I think we were not controlling the customer experience fully end to end. So I think the key was that from being a origination marketplace, we became a fulfillment marketplace. So like, I think a good example is Amazon, where Amazon, if you go and order on Amazon, while there are a lot of third party sellers who will sell to you, but Amazon ensures logistics, delivery, and they handle the payment. So we took the same model and we said, okay, money is fungible, money can come from anywhere, but how the money is delivered, how the money is collected back, is there ability to give multiple products, is there ability to give these customers an insight into their own businesses and all that. I said, let's control that, because that's the most important piece to enhance the customer experience and customer satisfaction.
but what was broken? Like the US financial system is very, very mature. I'm sure all the lenders on the marketplace would have had very mature processes. And like, what did you see as? Hmm.
Processes were mature. The only thing was that two things were: the one, it was like it's like every lender wanted their own set of documentation, which was 60
Yeah.
70% overlapping, but at least 25 30% was still based on their own criteria and everything. Secondly, it was lenders at that point of time had not really started investing in digital technologies, so they were still far behind to give that experience to the customer base. And then the third thing is that if the customer was looking for renewal, or they were looking for top ups and everything, then again they had to go through the same process again and again, which obviously once you have established a track record, then it should become a lot more seamless.
Okay, got it, got it. Okay, interesting. So uh, now the way to solve this problem, you want to lend without taking customer deposit, is to then have hedge funds as customers. Essentially, what you
Hedge funds
created.
were the one who were initially, because what had happened at that point of time was because of the mortgage meltdown in the market. Fed had cut the interest rates to historical lows, so a lot of investors were looking for yield
Hmm,
out there. So one part of the yield was to invest in equities, but the other part was also to invest in debt.
hmm.
Now, debt, you could put money in a like a fixed deposit or some debt funds, because the returns were like 0.5% or less than 1%. So that's where a lot of these hedge funds and credit funds were looking for some returns, and that's why they started coming to us, because they said that this is a good asset class. This has little correlation to the consumer was low, and then their ability to go and lend meaningful amounts of money and then earn good returns became very attractive over time.
What was the return profile like? Like how much was that amount earned from a
So
customer of
basically,
yours?
they were making 0.5 or less than 1%, and then on our platform, they were making like close to 9 to 10%. So obviously, that was a very big delta between the returns that they were getting. Actually,
This 9 to 10% is after accounting for NPA, like default and all.
yeah, yeah, yeah.
Wow. Okay. Okay.
9 to 10% net of fees and defaults and everything.
And what was your earning in it? What percentage were you able to earn as fees?
So it was 2 to 3%, actually,
Okay.
and then the rest was going, because obviously the investors were taking the bigger risk,
Hmm.
actually.
Hmm. Hmm. And was this better than what you were earning as a marketplace? This 2-3%?
It was it was somewhat better, but I think what happened because of that is the customer experience got better. So you could put more volume, you could add new products, you could go out and quote more business, because then everybody knew that we could take that final funding call and funding decision, which wasn't the case earlier. And that also helped us to just get even more data, because our whole promise was that if you give us more data, then we'll be able to give you better products, finer pricing. And this was also a start of getting these products generated and getting leverage from banks and everything, because then that juiced up the returns even further for the investors without charging more rates to the borrower. And then over time, then it became a win-win situation for everyone.
Okay, interesting. What kind of new products were you able to offer? Give me an example.
So we were able to do, like working capital against the credit card receivables, because US is a economy where digital payments are extremely high, credit card usage is extremely high. So we were able to do variable payment, where repayment products, where instead of the SMEs, sending out us money every month as a fixed EMI, they could have a variable cash flow and they could pay back, based on that. And that could come from settlement of the credit card payments. It could come from against their invoices. So streamlining the invoice factoring products. Because prior to going digital, every invoice used to be physically uploaded, then verified, then and then 80 or 85% of that could go to the borrower. Then after 2 months, when the payment was coming in, then you again notify the borrower. So imagine putting all this workflow fully digital and making it self-service. So we were able to launch these new kind of products, and the other innovation was that we were also able to say that, why do we need to collect one payment a month? Why can't we collect micro payments, which could be on a daily or a weekly or a bi-weekly basis? And that will give customers, especially SMBs, more handle on their cash flow, and also create a better outcome for everyone, including the investors, because it also reduces the risk for the investors and also boosts their return also.
Hmm. Okay, this is called revenue-based financing, right?
Revenue based financing, yeah,
Okay,
exactly.
okay, okay. So you were able to launch revenue-based financing. Uh, this structure with the hedge funds, did it operate through like creating a new entity, like say a special purpose vehicle, like an SPV?
Yeah, so we created a special purpose vehicle that was registered then with various states, because then in US the lending is a state subject. So then we registered with state regulators and everybody else, and then this SPV was dealing with the money part with hedge funds and credit funds at that point.
This SPV, like every hedge fund, you had a new SPV, or there was one SPV for all?
So we had this, like lending entity was one, but we had different SPVs with different hedge funds, because they didn't
Hmm.
want any co-mingling of the funds, and
Right,
also to
of
keep them
course.
bankruptcy remote and everything.
Hmm.
So that way we had separate SPVs, while the lending entity, which was lending the money across multiple states, was the same entity, which was being subject to regulatory stuff with the states itself,
Okay,
respective
okay.
states.
Okay, okay, okay. Got it. Interesting. Okay. So, y- you know what? how did I want to understand a bit about how you did the sales. And there are two types of sales which you did. One is SMEs, getting them interested in coming to the platform, taking a loan from you, and the second is the sales to these hedge funds. You can go in either order, but what did you learn about sales by getting both these set of customers in?
So SMEs we did because as I said, the smartphone came in and it was easier to discover SEO by then. Search engine optimization had become pretty effective channel for us, and then we also started partnering with large payroll and payment companies in US. Actually because they had also started realizing the value of it by then. That how to get that also started offering access to credit to their client because US was coming out of a big brutal recession at that point of time, and everybody was hungry to borrow more money and grow their businesses. So from a timing aspect, it was good. And secondly, from a marketing aspect, a combination between direct to SMBs, using both paid search and search engine optimization, because by like early 2012 2013, those products and offerings had becoming very mature in the US market actually. That how you did your SEO, how you did your paid search, how did you target the customer base, what you did with that. And then also partnering with large companies which had an inherent SMB base. They were interested because they were also getting a rev share from us, but more than the rev share, they were more keen to help their customers to grow because they knew that if their customers grew, then they will grow with them. So we did that, and then on the hedge fund and credit fund side, especially with credit funds and all that, once we had put out a track record for a year, then and that was a big reason why we headquartered the business in New York, because New York uh, is the Mecca of the capital in the world. So a lot of money comes there very quickly, globally. So it's easy to meet then these kind of investors if you are in New York and go and do a lot of work with them. So one thing led to the other, and then and these were short term revenue based financing, like a year kind of stuff. So you could prove your track record very quickly, and once the track record is proven, then people will come for that kind of return.
Okay, okay. But I want to kind of understand deal making from you. You have obviously done very high ticket size kind of deal making, be it with these hedge funds or I believe you've raised more than $50 million for the business so far. So how did you crack those deals with the VCs? Any kind of uh, lessons you can extract from it and share in terms of the
Yeah.
art of the
So
deal?
from an equity capital perspective, we have raised close to 65 $70 million, and the reason we didn't raise more money was not that we couldn't raise it, because we didn't need it, because we built a long term sustainable, EBITDA positive, profitable business, actually. So the idea was that from on the equity side, we really wanted to focus on, first, like creating the right product, not being in a rush to raise a lot of capital too quickly, because otherwise then you make a lot of mistakes, and then the that capital, you become a prisoner to that capital raise. Hmm. And then you are spending more time just trying to just like answer your investors than trying to build a core business. So we first built a business which was solving a lot of pain points, actually. That's why, starting from the name like Biz to Credit, which was very clear that what we were doing, to something like creating the right platform technology, focused a lot on collections and performance, because that was important. That it's not just lending money is easy business, it's getting the money back, having the right channel partnerships and everything else. So we did that for a few years, in a very focused way, and then we raised the money from the right kind of investors, especially from Silicon Valley, because they were starting to understand the opportunity and also the scale of the business, because US, the just in the SMB, the market size is like $3 to $4 trillion, actually. So obviously it's a big market, unorganized, not any big one or two players out there. So it made a lot of sense for us to go and then raise equity capital. But more than just equity capital, we also kept adding new debt players on our on our marketplace, because that was important, that we had a lot of liquidity, because for us, money is raw material. So we need to have that in order to keep pumping up our platform business, and running with it.
So, from what I make out, then your deal making philosophy is focus on solving problems and timing. Like these are the two key things. Like when the
Yeah,
timing is
yeah,
right.
yeah. I think you have to solve problems, and you have to play that whole long term. There's a saying in Wall Street, whether you are playing a short term greed or long term greed, kind of stuff. So I think that long term mindset is very important in this business, and not like, just like, this is not a business where you can flip it, like it's not like you're building out just a technology which will go viral, then people will start using it, and then you sell it. It takes time to build credibility, it takes time to build track record, and you're dealing with a lot of money, so obviously people will hold you to higher standards. So I think focus on corporate governance, focus on the right metrics, deliver what you are promising. That I think is very, very important, because once you have built the trust, then it's very easy to scale the business. So it will take few years initially in a business like this, but if people are focused, then they can grow the business very quickly.
Okay. Uh, was there credit risk? Was there like stress on your portfolio during COVID? Did
Initially, there was a
you
bit
see
of a
more
stress,
default?
but then US did an unprecedented thing with releasing such a big fiscal stimulus, especially for businesses, because US had realized that more than consumer, businesses needed all the help during COVID, and they were the ones who were going to be the main driver for job growth, as well as the economy to keep running during COVID. So US did a very smart thing by, like, channelizing almost 60-70% of the money that they released in the market, went to help small and mid-sized businesses, compared to consumers, unlike in other countries where there was a lot more money going to consumers, and that really helped these portfolios, and that also helps small businesses to weather the storm, and actually they came out more strongly out of that.
Okay, okay. So, like, you didn't see any impact on your portfolio.
So initially there was a bit of an impact for a month or two, but then it recovered very quickly, and then there was not much of an impact.
Okay, okay, okay. What's your loan book today, or what's your AUM, assets under management?
So see, we actually don't retain much on our balance sheet. So technically, we don't have a AUM concept, or what we have is that how much we
No, but
fund.
these SPVs combined, like that's what I'm asking.
Yeah, SPVs combined, at any given point of time, it's in few billions of dollars, actually,
Wow.
and then, yeah, but then they keep replenishing very quickly, because these are mostly short term ones, so not very long term. We don't do long term financing, and
Hmm.
then the idea is that we keep adding new products or new verticals, and then and keep adding on it. But then money also comes back very quickly, and
Right.
then and that can also get redeployed.
So there's a couple of $1 billion worth of loans that you're managing.
Yeah,
Wow. And this is all to US SMEs.
these are all to US SMEs, absolutely.
Okay. So tell me about the cross-border fintech play then. What was the birth
So
of
we
it?
started company Biz2X 6-7 years back, but even before we started the company, we were, by like 2017, 2018, a lot of banks and other financial institutions were approaching us across the globe, because they were also, because by then a lot of financial institutions had realized that they have to go and provide some kind of digital experience to their client base. Hmm. And then in US, some of our first partner was Citibank and HSBC and some large local banks. And once that started happening, then we set up a new entity, Biz2X, to focus on this part of the business.
So basically, people saw that you're giving digital loans and you're giving great customer experience, and they told you that sell us your technology.
Yeah, yeah, white label your technology to us,
Hmm.
absolutely.
Hmm.
So we
Hmm.
also thought that was a good diversification from us, because
Hmm.
till that point of time we were just in the lending business, and booking fee based revenue from the lending business. After that, we said that this is also a great segue into, and also offer products which we cannot offer as a non-bank, like government guarantee programs, some of the other credit card products and all that, which are traditionally done by banks in US. So we said this is a good way to also provide that to our customer base and also diversify from being just a lender for to the SMEs one way or the other. And then our play also was that, if we have access to more data, then we'll get smarter, because by then, machine learning and all that had already started. So the idea was, the more data we have, the smarter we become, the more we can do out of it.
So, like say Citibank, HSBC, they would do like a SaaS deal with. They would give you an annual subscription fees, and you would give them a white label platform which would power their SME lending.
Yeah, annual subscription fee, and in certain cases, annual subscription fee plus certain bips on the portfolio.
Ah,
Also,
okay.
and then we were the one who were deploying all the technology and everything, while they were in this situation, taking the final underwriting decision, and they were the ones who were servicing these loans. So we were not servicing these loans.
Hmm, hmm, hmm. Right. You were just a technology provider here, and you would probably
Technology, data
configure.
analytics, scorecards,
Right.
insights into the customer behavior, customer psyche, everything.
Hmm. But this data, which was feeding their models, would be proprietary to them, right? They wouldn't be comfortable sharing it with you for you to learn and build your algorithms.
No, we had actually by then built a lot of our own models, so they were leaning on our models also, because traditionally their models were more suited for offline, kind of business, not for online, like cash flow analytics or cash flow driven businesses.
Hmm.
So I think the difference became was that, we had more access to data than them, because they had only data for their client base. Now we had access to so many more data sets.
Okay. So when your model was doing the decisioning, that data would be obviously available to you. What does the model look like? Can you help me understand how does a decisioning model work?
No, so the decisioning model has more than 2,000 plus different now parameters. Depending on the kind of because now we have made it global, not just US based. So depending on the country, depending on the data sources, depending on what kind of business you are in, what kind of other channels that you're looking to address. So depending on all that, so predominantly a lot of it is still cash flow data, but within that we have also divided and subdivided it into other channels also. So the idea now is that, how do we go and look at it, and also we now look at source from where customer is coming. Let's say if they're coming through a payment processor, then we can get all the historical and ongoing going forward payment data. If they're coming from payroll provider, then we can see that, how much payroll they have run in the past, how many times they had a cash flow issue in running a payroll compared to where they are now and what they can do. So that's how we were that's how these models have developed over time, and they are very modular and very flexible also.
What are the answers which a model gives you? Does it just say a yes, no, yes, give a loan, no, don't give a loan, or what
No,
does it
no.
look like?
So it's like it starts there, but it also then rank orders it in terms of risk, pricing, term that you can do, what kind of products, and then it also calculates a probability of default, PD ratios and everything else also.
Okay. Okay, okay, okay. Interesting. Like how much amount can be given? What is the period for which
What
this
is the
amount should
amount
be?
period, whether it's secured or just based on cash flow,
Ah,
what is
okay.
the what are the other attributes of that loan that one needs to take into account. Let's say if the SME owner has multiple businesses or multiple entities, do we need to put a lien on them, or just on one,
Hmm.
whether we in like first position or second position in certain cases. So it calculates everything. It prices it. It also gives you out the kind of products you can do.
So, did you find selling this SaaS tool harder than selling to hedge funds, or like again, I'm trying
See,
to.
this is a different selling, because this has much longer lives, like decision making cycles. Because obviously, once a lender takes your platform, then they are also committed to it for years and years, and they are literally running their business on your platform. So, which is a big decision. but at the same point of time, we also started now providing them with a lot of origination volume insights and everything, so that makes their decisions a lot easier, in a way.
So, how are you selling? What's your customer acquisition strategy? Because this is like very high value kind of a
This
sale,
is
I
this is
assume.
high value. So we have a separate team for Biz2X, which just
Hmm.
focuses on enterprise sales, enterprise, customers. They go to trade shows. They will go and meet with a lot of customers. They do a lot of solutioning piece. Then we work with big strategy consulting firms like McKinsey and BCGs of the world now to offer this kind of a solution, to or to bigger, institutions and clients also. Actually.
Okay, okay, okay. Interesting. I noticed a trend that a lot of your sales happens through strategic partnerships,
Yes. Yes.
through payroll providers, through
Yes.
consulting companies.
Yes. Yes.
What is the uh, what are some best practices for onboarding partners who can sell for you?
I think the best practices are, one, you need to have alignment of your, purpose and vision. The second piece is that, you need to know that, what's the value or what's the pain point that you're solving jointly. The third piece is, looking into the aspect that, how do you go and, get some of these, you know, installations or implementation done in a time bound fashion. And then the fourth is, how can you help these institutions then to grow their own business.
Okay, okay. Essentially, I guess that would be the starting point, right? Like, how can I help my partner to grow? Like,
Absolutely. How do I help my partner to grow? What do I do with them? Are we helping them to, grow their business the right way?
hmm,
Are we helping them to increase their valuation? Does it help
hmm,
them to be look good in front of their investor groups and all that?
hmm,
Actually.
hmm. So the Biz2X product would be called an LMS, a loan management system.
Basically, it's a full technology stack that starts now with agentic AI CRM, like loan CRM. Then the LOS, the loan origination system, then the loan management system, and then the overall collection as well as portfolio monitoring and pricing.
Okay, okay. There are many systems rolled into one. Uh,
Yes, many systems rolled into one. Exactly.
who are the other companies who are offering such a comprehensive uh, solution?
So see, in different countries, we have different kind of companies, who are offering it. But I think where we are getting differentiated is twofold. One, since we also run a lending business, so we have a lot of now data and expertise from that side. So it's like Amazon AWS kind of a model where, Amazon builds everything for themselves first, test it out. So we are doing same thing with agentic AI, where we are testing out a lot of these agentic AI agents for our own biz to credit business, both on the sales side, underwriting side, and collection side, and then we are going to deploy it back onto a platform for Biz2X for our clients. The benefit of that approach is that, one, we are not learning at the expense of the clients. The second thing is clients like it because they get to know the best practices from us, because that's what
Hmm.
they're really looking to do. And then the third thing is that we are constantly innovating. We are constantly investing money into our own business, and we are also ahead of the curve in that sense because we are already understanding the problems, the pain points, which typically otherwise, if you're just a software provider or a platform provider, then you will wait for your customer to come in, or you will release the next version and all that kind of stuff. So in this day and age now, the version concept has totally vanished. It's like it has to be constant improvement, constant updates, and you typically don't charge your customers for that. I
Hmm.
think the other big innovation we brought in is that we don't have a concept of change requests. So we are saying that, guys, this is a standard platform. This is very configurable. You can build stuff on top of it, and at the same point of time, we'll keep updating. We'll keep adding new features, and then if you're on the platform, you will get it. Actually, it doesn't matter you took the platform 3 years back or 5 years back, and a lot of it is freemium kind of a model where a lot of these new features you can use for free, and then if you want the next version of it or higher duty stuff, then you're actually paying for it. So customers like it because then they don't have to worry about that are they being left behind and everything. I think the other thing
Okay.
they really like now more and more is that our expertise in digital acquisition side of the business, because we have become very good at that. How do you market? How do you market to new client base? How do you nurture your existing client base? How do you go about nurturing the overall the ecosystem play? How do you create these kind of closed loop networks, which really helps to gather more data and also give better insights to the customers or themselves. And then how do you also, because since we deal with the capital markets also, and we understand the investor psyche, so a lot of these, whether you're a bank or an NBFC, you're dealing with debt investors, you're dealing with capital markets all the time. Then you don't have to worry about that piece, because we are all we are dealing with that, and we understand, and we can actually come and be more proactive in doing this. Especially right now with the agentic AI, we are doing that. We are being very aggressively investing in our own business. We are working with a lot of partners. We are going out and solving a lot of these real life problems, and then also educating people and also sharing that information back with our Biz2X partners and clients, so that they can go and take those learnings and can actually either report it back to their equity investors, debt investors. If they're publicly traded, they can communicate it to the markets. If they are privately held, then they can talk to their equity shareholders, but also to the debt guys also, because that's an important constituency for them. So I think doing all these different things, really helps us and helps them, and it also creates a cycle of innovation, which is a ongoing, cycle.
What's the what's an example of problems that agentic AI is solving? How are you
So I
using
think
it?
I think agentic AI can solve three or four kind of problems very well. One is your customer onboarding, handling a lot of the customer inquiries, which are pretty. I won't say they are standard, but you can actually make them very smartly answered, and that creates a level of consistency and uniformity, So that is actually a very good use case for agentic AI, on the customer side. I think on underwriting and pre-underwriting, the good thing is that generating a lot of these credit assessment memos, and looking at multiple data sets which underwriters normally look manually, because these are clean structured data. So it's a lot easier for agentic AI to go in and start looking at that pretty quickly on their own.
But doesn't the model do that? What is the role of
No,
agentic AI?
models have to be trained. See, the problem right
Okay.
now in the whole AI space is that while there are these large language models, one, they're very expensive to run. They're
Hmm.
extremely inefficient, and without the clean data and without the ability to define the outcomes, those models, like running and administrating those models is like 10x more expensive than employing people, actually.
Okay.
So you have to have that ability to narrow it down, and then train it with real life data, and also monitor the outcomes, because there could be a lot of hallucinations and other things that could happen. So I think from that aspect it's good. I think the third aspect where it gets even more powerful is ongoing monitoring, because once you have done the deal, and the customer is paying on time, if they're not paying on time, obviously it gets pulled up quickly. But even if they're paying on time, how their cash flow is looking, is it deteriorating, how the overall business environment. A great example right now is that you have these tariffs coming in, and let's say if I have these exporters from India, SME exporters who are exporting to US, and they are being impacted by these tariffs. They could have a great business, but now the problem is that they will get impacted. So how do you measure that? So AI, agentic AI can actually do that very quickly, very well. Can run all kind of scenario planning. Can also, and the other aspect is we have like a platform known as virtual CFO platform, which actually like it's like literally a CFO sitting with you. They're analyzing everything. They can give you all the insights. They can also, and we have so many SMEs globally with us now that we can also benchmark your SME against them. If you're in similar space or similar revenue and all that, in which percentile you are, how to improve it, how, what are the best practices that you should be doing. Now that is something very powerful, but doing it with human beings or with credit analyst or with analyst, one is very expensive and not very scalable. So
Hmm.
that kind of, for me, AI is not like just running chat GPT or large language models. It's like building now. these small language models, these agents, and giving them a very clear cut task of what to do, how to do, and almost doing it all the time, 24 by 7, never stopping. Again, this part of the innovation cycle. And then you empower the businesses even more by doing that.
Okay. This virtual CFO is a free offering.
This is a free offering, so we don't charge anything for it right now, and but we have like large companies like Mastercard and some of the other large companies who have also licensed it from us, actually, and they are giving it out to their client base also. So the more it goes out, the more data we have, the more customization of, like, we can let the businesses just do run a customized stack on top of it.
Hmm.
And then our aim is that, okay, how do we monetize it, that we can offer them better products, so we start with credit, but now we are offering them, experimenting with insurance products and other products also. So the idea then becomes is that it becomes a much bigger play, and also makes your customer base more sticky, with you.
Hmm. Yeah, that's pretty amazing. It's like a very high engagement level if you have your virtual
Very
CFO
high
sitting in
engagement level, exactly.
customer's office.
Yeah,
I mean,
because they will actually almost look at it on a daily or a weekly basis, and
yeah.
then they will even feed in more data into that directly, actually.
Interesting, interesting. What's the ARR for Biz2X?
It's privately held, but it's like it's like pretty healthy. It's in tens of millions of dollars, actually. So, like,
Wow.
I would say
And this
closer to
bootstrapped, you
now,
didn't
no,
raise any
100
funds
million,
for
100 million plus kind of stuff. Plus,
100 million plus ARR.
yeah, yeah.
And bootstrapped, or did you raise funds for Biz2X?
No, so Biz2X is a 100% subsidiary of Biz2Credit itself. So whatever money we have raised is at the parent level. We didn't raise money separately for Biz2X as of now.
Amazing. $100 million ARR SaaS company. And I don't think
Yeah,
many people would even be aware that this is a $100 million ARR SaaS company. So it's easily a unicorn
yeah.
then, like as per how SaaS companies
Yeah,
are.
yeah, no, no, we are, yeah, because our revenues, Biz2X, Biz2Cred are very good revenues overall, and then yes, so from a valuation perspective, it's pretty healthy. I will just put it like that.
Amazing, amazing. What's the average contract value that you have with a bank, like say a Citibank or an HSBC? How much would the contract
So
annual
anywhere
contract?
depending from $1 million to $3.5, $4 million, actually.
Mm,
So that's the average
okay,
contract value.
okay, okay. So what's the road ahead then for both of these businesses? What's your
I think the road
bigger plan?
ahead is that Biz2Credit business, we are very clear, we are focusing on the US markets, because that's where there's still a lot of opportunity. Like, we did a report recently with BCG which said that just in US itself, the funding gap is still like close to $800 billion, actually, a year, actually, on the lending side. So we see a lot of activity, and action is just increasing, and with the advent of private credit, it's going to get even better. Biz2X, we have very ambitious plans across the globe. So obviously US, we are there, we have expanded quite a lot in UAE, in India. Now we are going very aggressive and big in Saudi markets, and we are seeing a lot of traction, because it's like, because platform business with data analytics business, once it's there, then it becomes a flywheel kind of stuff,
Mm,
and the more clients you have, the more clients want to come. So in UAE, we recently, like, for example, partnered with three of the largest payment processors. Now we have like 90% plus of digital payments data that we have access to, and we can build models, we can run everything on top of it, and then we see more and more traction coming in. India, we have signed up quite a few deals with NBFCs and some banks, and now we're also talking to folks like NPCI and all that, to even create a full embedded, from a payment to lending aspect, kind of stuff also. So the idea, so we see a lot of opportunity over next 3-4 years in these 3-4 markets itself, and these are large markets, globally. And we also see that, with AI coming in, cost of developing, writing the code, or go to market is reducing, and having a massive amount of data sets that we have, and even adding more and more data on top of it, is really helping us now to get a competitive edge in this space, in the AI space also.
amazing. Uh, are you looking at a public listing? Because you're
we
profitable.
we are we are planning to do something in early 2027, actually.
In India or in the US?
No, no. Most probably, we'll just do it in US itself, either on Nasdaq or NYSE, because one, most of our business is still there, and secondly, we find that the size of IPO and all that we want to bring. I think the Indian market will not be like that attractive for us from a global perspective.
What size are you looking at?
No, so in US, what happens is that if you bring out an IPO where your market cap is below $10 billion, then analyst coverage is not very good.
Hmm.
So it has to be above that, between, I would say, 15 to 20 billion at least, market cap, because otherwise, then you don't get the right kind of, uh, lift from an IPO.
Wow, incredible, amazing. Okay, I want to get your take on India versus US in terms of the fintech financial regulation industry perspective. You've seen both these markets.
Yes.
What do you think are the strengths and weaknesses of India?
India has a fantastic digital infrastructure. There's no doubt, and with GST and everything being centralized, so it's easier. I think the challenge in India is the financial, innovation. The regulator is still very, RBI especially. They're very scared of new age, innovation and thinking. Well, I think they're doing a lot of work with RBI labs and everything else, but that's more on the technology side. I think as a regulator, my view is that technology will take care of itself. It's more the regulatory mindset and letting people, like having more innovation on the side of, lending piece, especially in the SME space, because that's very important. I think that's where India is lagging behind, not just US, but also Middle East now. And that's where I think they need to improve their game, because in India, the access to credit, especially in the SME space, is very hard still and very expensive actually. So more than hard, it's extremely expensive. And I think the idea is that while all the major ingredients are there in terms of credit bureaus, in terms of data is there, digital infrastructure is fantastic. I think the ability to, like simple things like, in US, we could get rating agencies 2, 3 years back to come and rate these portfolios, and then insurance companies could start putting in the money. So we have been telling the government of India to do something very similar in this country, that they can unleash a lot of insurance money, which is here locally, into this space, which will be a win-win. Insurance companies can get better yield on their asset classes. SMEs will get more liquidity. It will generate more employment. The cost of money will go down, because insurance money is the most sticky money because of their premiums coming in. But I think that is something that India, as a country, has shied away from doing, and taking some of these more radical steps. And these are not radical anymore, they have become very mainstream, in like most of the world now. And in spite of having better digital infrastructure, better adoption, more centralized, play, till India doesn't take or doesn't open up the mindset on that side, creating that framework, like few years back, Niti Aayog had approached us. They wanted to set up a digital lending, like B2B entities, like, okay, don't take deposits, but, B2B, like what we did in US markets, and then accelerate the overall, access to credit and lending. But nothing really happened. So, like here, you still have banks and NBFCs, who are doing most of the heavy lifting, which is which is okay, but it's not still changing the, the landscape the way it should get changed.
Does India have a deep enough private credit market? Essentially, in the US, you're in the private credit market, right? The
Also,
capital
private
generated.
credit markets in India are getting deeper by the day. If you see all the AIFs getting set up, and even private credit funds, so there, and there's a lot of appetite among people to actually deploy money. You know, I think the problem is more on the side of the fact that, the private credit and all that is today still in India is not like as competitive as bank lending would be. Like, unlike in US, where now a lot of
You're
insurance money
saying
has
comparative from the borrower's angle for a
borrowers,
borrower.
yeah, from a pricing
Okay,
perspective and everything.
okay, okay.
What I think big innovation in US allowed was that, was it allowed insurance companies to start investing money in rated, instruments, in US. So that where, because once you have insurance money, then the arbitrage between banks and, insurance money, actually insurance money is even cheaper than bank money today. And that really helped the whole private credit, because now in US also you have private credit with different stacks. You have at the top, these are insurance companies. Then you have, your insurance company and pension funds. Then you have, non-rated securities. Then you get other, and then at the bottom is now hedge funds and all that. But in India, that hasn't happened, to that extent. While private credit markets in India are 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 expanding, pretty quickly. There's a big need for that also. I think because of these regulatory arbitrage, banks and LBFCs still play a very big role, which they should, but not as big as they should be playing, compared to where we are right now.
The tariff part we haven't discussed yet. That's what I
Yeah,
want to discuss. Yeah. Okay. So okay, you have seen the SME sector, and you have a lot of data about the SME sector in the
yeah.
US specifically. How is the current Trump tariffs affecting that?
See, the Trump tariff is actually both good and bad. So, from a good aspect, what Trump recently did was that he brought out a bill, big beautiful bill, where the tax cuts were memorialized. He also gave a lot of new tax incentives to the small and mid-sized businesses, actually in US, to offset that revenue shortfall. He's collecting a lot of money from tariffs right now, which was not happening earlier. So even S&P said yesterday that actually US credit rating might improve just because of that, because there's a new revenue source which can collect almost like $1 trillion a year,
Hmm.
and that can offset. So what Trump is doing very smartly, he's doing one thing. So he's saying, okay, I'm going to collect all this money from tariffs. I'm going to make all these countries come and invest in US, and I'm going to reduce the cost of doing business within US massively, whether it's tax stuff, whether depreciation benefits, whether investment in the infrastructure, lowering the energy costs very dramatically. So this is not as bad a strategy as a lot of people thought about it, initially. But obviously, if tariffs are too high, then it's gonna impact, a lot of, the good import in terms of inflation and everything else. But that hasn't happened till now because tariffs have not gone up as high as he had threatened, initially. So I think
But
in that sense, even if
do
he
you see
puts
stress
50.
with SMEs? Like, are SMEs? Is their margin being affected because they have to pay more? Are
Indian
they?
SMEs, yes. So the problem with Indian SMEs is that most of their exports are in low end, kind of, stuff, and their margins are not that high. And if now there's a 25% tariff, and if another 25% tariff comes, then it becomes a big problem. Then because then they cannot export from India. That's it. Then they will have to either shift their base or just stop exporting to US, which is tough because you don't have a market like US, at the end of the day. So US is the market to be there because, at the end of the day, there's no other way that you can just replace US market. So I think it will create more problem for India than for US, first of all. Second issue is
Are
going.
US importers able to pass on the cost to their customers?
Yes and no, but like what is also happening is a lot of other countries who have got a 15% tariff, they have depreciated their currencies by that amount, and
Oh,
or
okay.
closer to that
Okay.
amount, actually.
Okay.
So I think there is that war going on globally also, that okay, I will just like readjust part of my
Hmm,
pricing piece. Part
hmm,
5-7%, people have taken a hit. Part is that the currency depreciation is working in
hmm,
US favor. So I
hmm.
think for India, that's why it's very important to have some kind of a trade treaty done or understanding, because otherwise what will happen is that over next year and a half, because India has one of the largest trade surpluses with US, close to $50 billion.
Hmm.
If they don't address this issue, then this trade surplus will shrink very very dramatically. And then the other thing is also going to be that right now has not put any tariffs on pharma, because he also knows that pharma is mission critical. But I think over time even that production and all that will and can shift out from India, because see, pharma production is not very labor intensive, unlike other things. So if pressure comes, then a lot of that production will also shift out from India. So I think in my view, India net will have a very much reduced trade surplus. I will not be surprised that even that trade surplus becomes a trade deficit. But I think more than that, if India starts losing this export market, then that will impact India quite a lot from a manufacturing aspect and everything else also, because that's what Modi wanted to do. He wanted to increase the overall share of manufacturing in the GDP from 14-15% to 25%. That will not happen. And I think the other problem for India is that with AI, advent of AI, as it is, the IT services jobs are starting to shrink at a rapid pace. So that happens, plus this manufacturing whammy, and India is a country which needs a lot of employment right now, actually.
What's your advice to entrepreneurs in India? Should they even consider manufacturing, or should they just look at
I
services
think
opportunities?
I think they have to be very smart now, because if this tariff situation doesn't get controlled, then they will have to move their bases. They will have to go to Middle East, or because like in UAE the tariff is only 10%. Actually,
Hmm.
or in places like Vietnam and all that. I think they'll have to take steps. Otherwise, or government of India says that okay, we'll depreciate our currency by 20%. That will not happen.
Hmm.
So I think it's going to be tough. It's going to be tough, for a lot of Indian exporters. Unless they are manufacturing something which is so great, that people will still take at a higher price, because 25% is already steep. 50%, you cannot run a business if you're,
Yeah.
if you have to cut your margins by 50%, actually.
Hmm. Though that additional 25% might just be a negotiation tactic rather than
Yeah.
something which actually happens. Yeah. Right. Okay. Awesome. Thank you so much for your time, Rohit. It was a real
Okay.
pleasure.
Thank you.